All right, what up, people? How y'all doing? We got another good one. So today we're gonna talk about trading the fair value gap for beginners. What is a fair value gap? So you ever been listening to a trader or watching YouTube or something like that, and you heard somebody speaking the terminology? They say, "I'm waiting for this gap to get filled," or "This gap is gonna get filled here," or something of that nature. And you was wondering, what do they mean by gap? So this is what they mean. So pretty much, a gap is pretty much price just jumping, just exploding and jumping, you know, uh, up real high or dropping real low, like an impulsive move. So just say you got regular price action, right? Just moving, then it just shoot up. That's going to create a gap majority of the time. So that's to the upside, to the downside. Say you got price action, just moving. You got a big drop down. For the most part, that's going to create a fair value gap. So pretty much the area in between here and here, between here and here. So to the upside, this move right here, the move before the impulsive move, and then the move after, these two is on the outside. And so the inner move would be the gap. So that's how it look on a line graph. Now, what does it look like with candlesticks? I'm about to show you. Now, with candlesticks, just say you got a candlestick, candlestick. Now, this candlestick is the candlestick before the large move, the big jump in price. And then this one is the one after. So just think about a three-piece combo. So you got one that starts to move, then you got two, the big impulsive move, then you got three, the candlestick after the impulsive move. So between one and three is two. So if you look back what I just showed you on a example prior, and I said this move before the big move and this move after, and I said in between is the gap. So the gap will be here. So wherever the bottom of the wick is on the last candle and the top of the wick on the first candle. So candle one, wherever the top of that is, it might just say if it don't have a wick, it might be a candle without a wick. So just say it don't have a wick. So top of here and then the bottom of this third candle, first and the third candle. So this space is, is the gap. So basically what it is this is an imbalance. Sometimes they call it an imbalance. So just say for instance, re normally you would want to see, just say, let me get this out the way. From candle 1, candle 2, candle 3, you will want candle 1 and 3 intersecting. So what did that mean? If you take the top of candle 1 and bring it all across, it should hit somewhere on candle 3. It could be like that. Just say this didn't have a wick. It could be like that, still intersecting. Now, just say this didn't have a wick. Now, if this goes across, it's not touching it. It's not intersecting. Candle 1 and 3 is not intersecting. So that will be a gap. And so let's see. So pretty much now this will be like a little gap, but like in between here, but it still is a gap. But normally you would see, you know, like just say if I come across here, that's intersecting with that little wick. And so just say if I do this, now it's intersecting, or it might be a long one. Now, how does it look if, just say for instance, okay, let's do this. Let's get rid of this. Let's do this. World. We're gonna do this like this. Do this like this. Let's make this look more like a, oh, come on. All right, forget it. Y'all get the point. Now, we're gonna go through it. It's, let's say A, B, C. Now, is A a gap? Is it a fair value gap? Does it have a gap? So again, we're gonna go from candlestick 1 and candlestick 3. Here's 2. Now, if we go at the top of candlestick 1, go over, then we go to candlestick 3, the bottom, and go over. Is it a gap? Yes. What about B? Go over from 1, come over 3 is a gap? Yes. Because, okay, we'll explain after. Now, what about C? If we go over, is it a gap? No. Now, C is not, we know, because candlestick 1 and 3 is intersecting. So if we take the top of candlestick 1 and go all the way across, it touches candlestick 3. Now, B, if we take candlestick 1 and go all the way across, it doesn't touch candlestick 3. So all this is the gap. Same with example A. You go candlestick 1, the candlestick before the impulsive move, and then the candlestick after the impulsive move. So even though this have a wick coming down a long wick, it still don't intersect with candlestick 1. So all this. Now, when it comes to trading, how do you trade the fair value gap? So real quick, want to keep these videos under 10 minutes, probably over 10 minutes now. So just say you got some price action going on. Got price action going on. Now, let's just, oops. Okay, let's do that like that. Now, far as trading it, so this how we're gonna do it. So this candlestick before the right here, before the big impulsive move, and then this will be candlestick 1, then this will be 2, then 3, the candlestick after that impulsive move. Now 1 and 3 will create a gap. So this is the wick, bottom of 3, top of 1. So this area right here is all a gap, right? Now, when you're trading the gap, so just say So this is bullish. The green candle was going up. So once you make a fair value gap, if you make a line from candle one in a set of three, one, two, three, on one, the bottom of the candlestick, whether it have a wick or not. If it don't have a wick, you do the bottom of the body. If it have a wick, you do the bottom of the wick. Just bring that across. Then the top of the candle, bring that across. Now, the bottom of this wick on candlestick 3, this all would be gap. Now, to trade it, what people normally would, what we would do is, as this impulsive move goes up, then you got the candlestick after the impulsive move. This area right here, if you look, think back to the last video, the top of this and the bottom of this candlestick, this create what we called in the prior video, either demand or order block. Now, when you have a fair value gap, so just say if you have a bullish one, you should have one that's going, is bullish, and you get a impulsive move up. The fair value gap, what it's normally going to do at some point is going to come back down and test this area right here, this demand or this order block area is going to come back at some point. It may be here, it may be over here. Now, if we look at this example, it came back right here and tested it. Now, sometime it'll come right here and just reject off, or sometime it might come down here a little bit. But what it normally do is it sets the mood to go back up. So it has a big impulsive move up. This gap, all this in here, this gap has to get filled. So that means it has to come to this point, to where the gap start. It has to come to this point right here, the top of the order block or the demand area, whatever you want to call it. Once it comes there, then all the orders that's here in this area, they come and sweep them up. They come and grab them up. So they fill the gap. Now, let's see what else we want to talk about with this one. Okay, so basically, yeah, so you have the candlestick, then the impulsive move, then another candlestick, and when it create a gap, then price action at some point you're going to come down to where the top of the gap where it starts at, and under there is this area which is create an order block or a demand. If it was at the top, it would be supply. So but it has to come back down to test this area so we can make a move back up. So basically you're gonna see this basically like an N. Just imagine the N. So you're gonna have candlestick, then supposed to move up, then you're gonna have this candlestick, whatever however prices you're gonna do. But at some point it's gonna come back down and test this area. And if it don't continue to break through, most times it's gonna bounce It's gonna reject and go back up. So when people trade in the fair value gap, if they have a posted move up, they know it's going to come down at some point. So they wait for it to come down, and then this one they set to do a buy, so they can go long. So a buy or a long just mean that they saying they're going to buy and not sell it. If they selling it, that means they're going to short it. So so when they buy, that means they expecting it's going to go up. And so basically, they know it has to come down to go back up. It has to come down to test this area to go back up. And so if we want to do it, let's say if we want to do bearish, just say you got price action, bam, however you want to do it, and bam, get some bullish in here. Do 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 do. However, now if it's up here, so in this case, this would be the first candlestick before the impulsive move down. Then this is the next candlestick. So this would be 1, 2, 3. So if you take this wick at the bottom of 1, come across, you take this wick at the top of 3, come across, this area is the gap, fair value gap. Now, on this one, they expecting, okay, so remember this first candlestick that starts the impulsive move right before the impulsive move, do the top of that, bottom of that wick, top of that wick, and they give you this area of order block, or if it's at the top, what do we call it? Supply. So this is supply area or order block. Now, remember, on the other example right before this, it was an N. So this is going to create like a inverse N. So the big impulsive move, then they're going to expect for the price to go back up and test this supply line or order block, and then it's going to come back down. So when they see a fair value gap, when you're dealing with bearish, then what they're doing is saying, okay, we want to continue to trade down. We want to get shorted or sell it, but we know it got to go back up first, then it's going to come back down. So we got the impulsive move. So you got to fill this gap right here between candle 1 and 3, this area here. So it got to area here. It got to come past this candlestick or wherever it is down here. It's going to have to come up, and then this part right here. So we come all the way across. This almost got it, but not quite. So just say the next candlestick something like that. So then they would expect it to be about to come back down. Might just test it. So then they're gonna expect it to come. They're gonna be expecting it to come back down. So down. Then at some point they're gonna come up, test this line. At some point they're gonna come back down. And so when they go and test this line, then they will get in a position of shorting it or selling it. You know, so with options, you have get in a position of a put. So, but they're gonna wait till it come up and test this. Some people will wait till it, test it and then start rejecting it over for the next candlestick. Some will just wait for it to come here and then just get into a sale. But sometimes it can trick you. It can continue to go. Price can continue to go. But hopefully that helped. That's fair value gap in a nutshell for beginners. All right.